Welcome to a continuing series on the reform of the Kenya Income Tax Act, and in this session we're going to be looking at the role tax incentives play in the economy. With me is Steve Okello. He's the head of tax for PwC Kenya. Welcome, Steve.
Thank you, Titus.
So there's been a lot of discussion around tax incentives and what role tax incentives play in the economy and whether they are useful or wasteful, whether it's a waste of potential government revenue. What are your thoughts on tax incentives?
Titus, my thoughts on tax incentives are, if they are well thought out and underpinned by an enabling legal and regulatory environment, they really should spur economic development. Case in point, if you look at the Far East, look at countries like China, countries like Singapore, Indonesia, they've had tax incentive schemes that have borne the reality that tax incentive schemes can actually spur economic development. Closer home, you look at Mauritius, and of late, you look at Ethiopia. There are a lot of investments going into Ethiopia. Ethiopia, being one of the most poorest countries in Africa, has actually revamped its Income Tax Act about 3 years ago and really incentivized investors to invest in Ethiopia through the provision of tax incentives. And it's working very, very well in Ethiopia. Something that I feel that can be duplicated across most of the developing world. But it's not just tax incentives. Other factors come into play. You have issues of infrastructure.
Yeah.
You know, the state of the infrastructure really has to be taken into account. Road networks, electricity, water supplies, and all that. That comes into play. Security situation in a country could impact investors coming into a country. So other factors come in play. But when I look at specifically at Kenya, the tax incentives that the current Income Tax Act has is out of date. We all know that the Income Tax Act in Kenya has been there for the last maybe 30 years, even more than 30 years, maybe 40 years. So my take is that tax incentive schemes need to be better targeted. The eligibility criteria for tax incentive schemes need to be changed, and maybe the opportunity will be there with the new act. So you need to have better eligibility criteria. You know, I think tax incentive schemes need to be time-bound. The current one that we have outside the EPZ or specialized economic zones, they are the ones that are time-bound. The other ones are just open-ended. Mm-hmm. So I think the eligibility criteria needs to be properly defined. Is the tax incentive creating jobs? Is it resulting in job creation? What is the actual economic impact of the tax incentives? The current one has had too much focus on the location of the investment. You know, certain locations outside, you know, the principal cities are the ones that enjoy an enhanced incentive. But I don't think that really should be the factor. Tax incentives should not be bound by the location of the investment. So the eligibility criteria has to change. I really hope that will be the change that we'll expect to see in the new income tax bill. So circling back, tax incentives, I think, spur economic development.
And if I just pick up on one of the points that you've made, that investors look at a number of factors. You've talked about infrastructure, you talk about security, and there's also the skill of the labor skill, the cost of labor. Is there a direct correlation between tax incentives and the decision by investors to invest? Do you think there's a direct correlation?
I think tax incentives play a determining role in the final decision that is made by investors to invest in a country. It actually plays a final role. I must say, as a tax practitioner, I've seen it. You know, when I have new investors come into town, you know, they'll ask for a rundown of what the economic situation is in the country, what the political situation is in the country. And even once they've made up their mind that they're going to invest, they always want to ask, what are the tax incentives available for investors such as ourselves? So tax incentives, I would say, is the icing on the cake. Yeah? Tax incentives give that edge. You know, if a country has good tax incentives, it provides that extra edge for an investor to invest in that country. So it is a factor in the determination of investment in a country, but it tends to come at the tail end. Other factors will come into play. Like we said, the environment has to be enabling. Mm-hmm. Yeah, infrastructure has to be in place and all that. But tax incentives really play a part. I can give you an example. Many years ago, I worked in Nigeria, and one of the largest mobile telephony companies that set up in Nigeria about maybe 20 years ago now, set up because they were attracted by what's called a pioneer status in Nigeria. So a pioneer status in Nigeria requires or allows an investor to enjoy 5 years tax exemption, full tax exemption, no taxes, no income taxes at all for the first 5 years. So this pioneering company invested in Nigeria through the attraction of that 5-year tax exempt period, and has remained the largest mobile telephone company in Nigeria ever since. So it took advantage of the tax incentives, built quite a bit of, I imagine, working capital, and staved off the competitors ever since, and has remained the largest telephone company since.
I mean, if someone was a skeptic, and I'm not saying I'm a skeptic, but if one was a skeptic, we would say sometimes that African countries might be tempted to use tax incentives to compensate for maybe a poorer level of infrastructure or a lower skill of labor. And so it's not that necessarily that tax incentives are geared towards helping the companies or attracting companies to invest, but you are compensating for a lack of attractiveness on the other factors. Shouldn't these African countries instead work on infrastructure, work on improving the labor skill, rather than providing tax incentives?
It's a balancing act, really, if I look at it. It's a balancing act. It's almost a chicken and egg situation. Which one really comes first? To build infrastructure, you need funds. Those funds really ideally should come from taxes. For taxes to arise, there has to be businesses that are in operation in that country to create the taxes. But how do you attract the businesses in the first place to that country? A moribund country, dilapidated infrastructure. What else can you do to attract the companies? There has to be something. There has to be a carrot on a stick to lure them in. So I think what African countries are trying to do is, it's more like a balancing act. Create those incentives through, reduced taxes, and then maybe other incentives as you work on your infrastructure. Then at some point, there'll be almost like a balancing off, whereby there'll be a natural attraction because the infrastructure is good and the tax incentives are still there. There'll be a natural attraction of companies coming into that country. So at some distant point in the future, that developing country might actually become developed. And at that point, I sincerely believe that the tax incentives should be sort of gradually pulled away. If you look at the developed countries, Sweden, Norway, and so on, they really don't have tax incentives, and the tax rates are extremely high, purely because they went through that exercise many years ago. They no longer need tax incentives. There's that natural attraction because everything, I think, has fallen in place. So African countries, I think we're still maybe 30, 40 years behind, but at least we've started the journey towards making use of tax incentives just to improve and to drive our economic growth.
Okay. And on a practical basis, if you look at, I guess that one of the most prominent tax incentive scheme in Kenya, which is the export processing zones, they haven't been as successful as one would expect, despite all these tax incentives that are provided within the EPZs. We haven't quite replicated the success of, say, China or Vietnam with the export processing zones, and obviously now we have the special economic zones. What do you think probably what was the extra thing that was needed in the EPZs, or what did we miss out on in respect of that regime?
I'll even extend the question. There's not been much success even in the manufacturing sector outside an export processing zone. Manufacturing as a contribution to GDP over the last 50 plus years that Kenya has been independent has never attained the 10% threshold of GDP, despite a lot of tax incentives that have been targeted at the manufacturing sector. The same incentives have been applied for the export processing zone and of late the specialized economic zone. My personal experience with the lack of take-up or the lack of success of export processing zone and specialized economic zones has been other factors outside tax. The environment has not been enabling. I actually had a client a couple of years ago that actually set up an export processing zone facility in Athi River in Nairobi, not far away from here, about 40 kilometers away. The problem was, for the staff, which included a substantial portion of expatriate staff, for the staff to move from Nairobi to Athi River on a given day, it took them 3 hours one way. It took them 3 hours to come back. So that's 6 hours getting stuck in traffic. 6 hours out of maybe a 10-hour working day. That extraneous issue just made it not to be viable. Too much time was spent in traffic. Why? Because the road infrastructure between Nairobi and Athi River was not good enough. Despite the expansion of that road, there are still massive traffic jams even as we speak today. So tax incentives have to be in addition to an enabling environment that has got nothing to do with tax. So I think that balance, we've not really gotten to that balance yet. So we still need to be working on infrastructure as we, sort of try to push in the tax incentives. So we have work to do that's outside the tax region. That's where I'd put it.
So you've spoken about manufacturing, and obviously manufacturing is one of the key pillars of the Big Four agenda of the government. The others being, I think, universal healthcare and food security and housing. What other tax incentives can be provided for these other pillars of the Big Four agenda to kind of foster their success?
I'll still start with manufacturing. Despite the lack of success in the manufacturing sector, I still would say that the new Income Tax Act should still retain the incentivizing provisions that exist in the old act. And some of the provisions that actually scuttle back the incentives for manufacturers should really be removed. There's a tax called compensating tax, which is basically a clawback of the tax incentives that one would have enjoyed as a manufacturer. So the compensating tax, which has been in our statutes for the last 25 years, should be removed in the new Income Tax Act because it's a disincentive. On one hand, you get a tax incentive, and through compensating tax, that tax incentive is really just taken away from you. Mm-hmm. So compensating tax should be removed, but the various incentive sort of allowances that are available for manufacturers should be retained. The 100% and the 150% investment deduction. Those really should be maintained. There's been a move by the government on the housing, which is the other pillar. There's been a move by the government to try and incentivize big-scale developers, to set up residential housing, for Kenyans to live. So a couple of years ago, the corporate income tax rate was reduced for such investors from 30% to 15%, so there's a 50% reduction. But the investor needs to construct a minimum of 400 residential units in a year, which I feel is too high. That's basically 1 house a day, more than 1 house a day. It's too high to have to construct 400 houses to get the special benefit. I believe what the government should do in the next bill, or the next Income Tax Act, possibly is to reduce the number of units that should be developed from 400 maybe to about 100. Okay. Then when Kenyans take up mortgages to invest in housing, there is a mortgage relief that they're entitled to, but the amount that is provided by the current legislation is very, very low. Okay. It's about 300,000 shillings a year, which is like $3,000. Yeah. That's really insignificant. So that amount really should be doubled, maybe $6,000 a year, if not $10,000, a million Kenyan shillings. So there are initiatives that I think that the government can do both at the investor level. This is the company that's constructing the houses, and also the individuals who actually take up the houses. There should be incentives on both sides such that, everything is pushed towards creating or developing affordable houses for Kenyans as part of one of the 4 pillars that the government is considering. There's also health. Yeah. But there's absolutely nothing, as far as I know, there's no incentive within the Income Tax Act, the existing one, that provides incentives for the health sector. There could be something in the VAT Act, but there's nothing, absolutely nothing in the in the Income Tax Act. So my suggestion there is contributions to the NHIF, National Hospital Insurance Fund, should actually be made tax deductible for employees, such that they get a bit of a tax rebate as long as they're contributing to NHIF. Something similar exists in a lot of countries across the world, which I think the government should emulate.
Okay, if we just switch gears for a second, looking at the US, they have significantly reduced their corporate tax rate in the past few months. And our tax rate has remained stable at 30%, which is more or less aligned with other countries in East Africa. If you look at the PwC World Bank ease of paying taxes, Kenya's effective corporate tax rate is at 37.4%. Is there any headroom for reducing this corporate tax rate? And if there is headroom, should it be reduced?
Yeah, Titus, there is definitely headroom to reduce the headline tax rate for Kenya, much as it is within the general benchmark headline rate for the rest of the countries within East Africa and really the larger part of Africa. But I think the timing for Kenya would be wrong to reduce it at this point in time, and purely because Kenya, right now, we are facing a fiscal deficit. The revenues that is being generated from tax vis-a-vis the expenditure that the government is expending on various projects, there's a significant mismatch. There's a shortfall in revenue vis-a-vis the expenditure. So by reducing the headline tax rate, we'll just be exacerbating the situation.
Okay.
So the timing is really just wrong.
Okay.
We know that if even there was a need to reduce the tax rate from an income tax point of view, there could be a corresponding need to increase the rate of VAT, just to compensate it. So it ends up being a zero-sum game. I think Kenya's focus really should continue to be to create enabling environmental structures and infrastructures to enable investors to come in, and really to push for economic growth in the medium to long term. But we have to keep on revisiting the issue of, keep on looking and sort of benchmarking ourselves to see when the time will be right to look at the reduction of the income tax headline rate. But the timing is off for the moment in time, and really it should remain that way in the medium term.
Okay. Thank you very much, Steve Okello. Obviously a very interesting topic, and hopefully some of the current tax incentives that are in the Kenya income tax will be retained in the draft bill. And we look forward to welcoming you once a draft bill is released to see what has been retained and what further incentives have been brought in.
Thank you, Titus. I look forward to revisiting the issues.